Organic food fight! Investor Beat starts now. Thanks for watching. I'm Allison Southwick, and joining me in studio is Jason Moser. Big news we're going to start with today is that Whole Foods hit lows not seen since 2006 after announcing second quarter earnings after the market closed yesterday. The company missed on the top and bottom lines and cut its guidance for the third time for 2014. The company is blaming growing competition. So Jason, full disclosure, I own Whole Foods shares, and co-CEO John Mackey is on the Motley Fool's board of directors. So personally, I'm very invested in this story. Am I supposed to double down? Do I sell? Do I hold? What do I do?
Well, my daughters own shares of Whole Foods as well, so they're interested and I'm interested. We're all interested. Let's look at this from the glass half full perspective, okay? Because it's really easy to look at it from the other way around there. But I mean, they did grow sales by 10%. Comps came in at 5%. It wasn't like it was a bad quarter. It didn't meet expectations. And worse was, really, they're showing signs of that competition that you were talking about. So what that means is they're going to compete more on pricing. It's not a secret. We've seen this coming. We've written a lot about it. We just didn't know when it was going to happen. But it's happening now. So they're going to compete more on pricing. As they lower prices, that means their margins get squeezed a little bit. They become a little bit less profitable because there's more competition out there. That's not a secret. That's going to happen. But you still have a very strong management team, and John Mackey, as you mentioned, and Walter Robb. They are nurturing a very popular and loved brand by many, and they still have a big runway of growth ahead. I mean, at 375 or so stores today, they're going to get that close to 1,000, maybe even a little bit more over the course of the next decade and beyond. So yes, I mean, today really hurts for Whole Foods investors. I think today is an overreaction. I mean, the call last night was kind of brutal on management, but if you look at this thing a little bit longer out, and I think that the story still rings true. Still a lot of opportunity there. I like the stock from today's levels. I think it's a market beat from today's sell-off.
All right. Well, Dow component Disney is up big today after announcing second quarter earnings. According to CEO Robert Iger, they turned in the highest earnings per share in the history of the company. So Jason, I didn't listen in on the conference call, but I assume they started it with a rousing chorus of Frozen's Let It Go.
The only thing missing from this call was that they were going to change, or they were going to add a new business segment to the business, and it was actually going to be one dedicated solely to Frozen. I mean, it's just unbelievable what this movie has done for Disney, and they always do this, right? They bring some great movies out. The content is just never ends. The thing is, when you look at what the content contributes to, it's only 6 to 8% really of operating income. It's not the biggest moneymaker for the business, but by the same token, it carries over into other parts of the business. So you look at the parks and recreation, for example, and they continue to bring more and more traffic in there. They use all of this content, those characters, to make those parks more attractive for people to come through. And there's this tremendous amount of operating leverage that trickles down to the bottom line as they grow the traffic at those parks. Because you got to figure they pay the bills to keep the lights on there, they keep the parks open, they got to keep them staffed. Those are all fixed costs that exist. So the more people they bring in, the more profitable those parks become. And when you see a company Disney's size growing their top line revenue by 10%, to me that's just phenomenal. They have a lot of different ways that they do it. I mean, the stock has been on a tear, and I don't see any reason for it to stop.
Groupon is down after announcing first quarter earnings last night. Revenue was up 26%, but offset by the company shelling out money on acquisitions and marketing in efforts to become an e-commerce site. I have not checked in on Groupon for a very long time. Not to say I left them for dead, but what is Groupon's long-term vision here?
It's okay. A lot of people left them for dead. I mean, okay, this is sort of a good news, bad news scenario. The good news is that management recognized that being a daily deal site wasn't going to cut it. It's just not a business model that works long-term. The bad news is that they're trying to move into becoming more of an e-commerce site. And hello, you're a little late in the game there. Amazon is going to be a formidable competitor there, and Walmart is also investing a lot of money in growing out their e-commerce operations. So when you look at Groupon, I like what they're doing there, but the cost of acquisitions, they're getting killed by shipping costs. If you're looking for an e-commerce play, Groupon is not the way to go about it. There are plenty of other ways to play it. I'm steering clear of this stock altogether.
All right, Jason, well, that's going to do it for today. Let's look ahead. One stock on your radar.
It has been brutal for growth stocks here the past few weeks, and Tesla's earnings come out today after the market closes. It's no secret that this stock has been on a tear, and there are a lot of people out there questioning its valuation today. they're going to need to really, bring something pretty special here to justify that stock price over $200. Otherwise, it could get a little dicey. I like their message overall, but this is going to be one that could be in a little bit of trouble valuation-wise.
All right, well, the Motley Fool is taking off for the next 2 days for our annual company meeting, so we will see you on Monday. Try not to miss us too much. For Jason Moser, I'm Allison Southwick. Thanks for watching.